Here to talk markets, Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. And I would say for a couple of months, actually longer, you've been feeling pretty good about things.
I have,
and
yeah.
Still, and even after all this recent stuff, I think the way you phrase it, the bell curve between stagflation and recession, there's a lot of room for things
not so much room in between. Yes.
That could be good.
Yes, exactly. And I think that, what we've been pointing out is that in conversations with clients, I feel like there's been this swing from the world is ending, we're going into a recession, to inflation is out of control, it's stagflation. But there's, 98 or 96% of that bell curve is, all the rest of the scenarios that are more likely to happen. And I think that what investors may not be appreciating is that the economy is actually doing okay. Maybe it's slowing a little bit from last year because of things like fiscal impulse and, other factors. But consumption is still healthy. People are still gainfully employed. The layoff cycle seems like it's not necessarily amplifying. I mean, so far during this earnings season, we've heard some layoffs, but nothing to write home about. So I still feel like we're in a spot that's, kind of a glass half full view.
About a month ago, I think, it's crazy art, and I've got it in the notes here, that they found it. Big argument between two Bank of America strategists. So you got Michael Hartnett, your guy who's head of investment, and you, who's head of the quantitative strategy.
US
yeah.
equities,
Okay.
Yeah.
So you were saying things really are not that euphoric yet. He was thinking you're starting to. He was saying you're starting to see some euphoria manifested in the Magnificent Seven.
Right.
So we have. He may have been on to something in terms of this recent pullback that we saw. But you still say there's still, now there's even less euphoria than when that article.
Exactly. I mean, the Magnificent Seven was crowded. That was not our favorite place to be. We were underweight information technology heading into this year. For a couple of months, that was not the right call, but it's starting to play through. But I think the idea is there's more in the market besides AI CapEx takers. There's more to the S&P 500 than just semiconductors and software companies and, Meta and these, mega cap tech companies. And I think what's happening now is we're seeing the market broaden out, and other companies are starting to beat earnings expectations and rally, but the Magnificent Seven is kind of dragging everything down. Maybe that continues a little bit longer, but I do think that we're in an environment where the health of the consumer and the corporate is still not imperiled by anything we're seeing in the macro data.
I mean, it hasn't been much of a pullback, but then yesterday it looked like it might turn into something worse, maybe 10% instead of just 5%.
Sure, and 10% corrections are kind of normal. I mean, they happen once a year on average. 5% pullbacks happen 3 times a year on average. So, it kind of felt like we were due for a pullback. But I think what's going on right now is we're still in that wall of worry type of environment. And I think there is euphoria in certain themes like the Magnificent Seven, like, GLP-1, other areas of the market. Maybe it's moving into power now, the idea that we need all this power to fire up the chips and, get this AI theme going. But I think that at some level, when you look at positioning of any kind of asset owner, if you look at pension funds in the U.S., they have the lowest allocation to public equities that we've seen since at least the 90s. And the reason is everyone's gone into private, illiquid, real estate, private equity, private credit. Public equities are like the forgotten land, except for these few companies that have led the S&P 500. Nobody loves small caps. There's a huge array of U.S. equity opportunities that are really flying under the radar today, and that's what I like.
If you did have to pick a poison, would it be that growth is slowing or that inflation is sticky?
I think that if growth is slowing, we're going to be wrong on the view that you don't want to be in these mega cap tech companies. But I think if inflation is sticky, you really want to be in equities, definitely more than you want to be in fixed income, because equities, they earn and their earnings are nominal, whereas fixed income is literally, by definition, fixed income. And for retirees, which hold the bulk of assets out there, what do you need in an environment where inflation is sticky and yields are still kind of low? I mean, 5% isn't crazy high. We've seen higher yields in prior cycles. You want to own inflation-protected income, which I think is the reason to own the S&P 500.
I mean, we really did go from, I guess you can't be in Goldilocks land that long, but we were 3.5 GDP.
Yeah.
Inflation trending in the right
Around
way.
The threes.
The Fed can cut 3, 4, 5 times. The economy's strong, but inflation's low. We're going to be able to cut. And then that was all. It went up in smoke.
Changed, though. We had 1 quarter of like a slowdown in GDP. We've still got hot services demand. We've got consumers still spending. We've got balance sheets still okay. Delinquencies are rising. Things are normalizing. But we're not going off a cliff. But I think that's the view that the average investor has.
And you think, were you surprised Leisman said we could get a couple of cuts still?
Yeah, I mean, I think he's talking about the Fed's framework for it. Still leaves an opening.
You think?
I think there's a very high probability the Fed does nothing this year. Or maybe even we get another hike.
That's
and I think that would be okay.
But it's okay if the economy's strong.
Exactly.
Well, it's necessary if the economy's strong.
Yeah. If the economy is strong,
it could be because something else falls apart or breaks.
Right.
Like that's
I don't know why we're hoping for rate cuts,
Exactly.
because it means something is breaking.
I still think Jamie Dimon might be right about that. That would be the scariest thing.
Stagflation argument.
Yep.
Is that it's not under control and they need to keep going further, even though the economy is already slowing.
Well, if we are in that stagflationary setup, what do you want to own? You want to own equity income, high dividend yield, utilities, energy. You want to own equities. You don't want to own bonds in a stagflationary environment. And I think that's the critical message. There is still a huge glut of assets.
But what do you do with all the
fixed income.
risk-on stuff? I mean, the NVIDIAs and the Magnificent Seven stuff and everything else in that environment.
I think we're in a stagflationary setup. You look for the folks that are generating the highest free cash flow. And that is, right now, it's energy, financials, some tech, but not all tech.
Right.
You look for companies that aren't spending on CapEx. I think what's different in the Magnificent Seven today versus last year is that these companies are actually spending on CapEx. And they're not firing people anymore. Last year, they were firing people and cutting CapEx. They were shoring up capital, and they outperformed. Their earnings were the best game in town.
Right.
This year, they're spending, and they're not necessarily cutting costs. And I think that's the difference, is you're seeing other areas of the economy actually accelerate, whereas megacap tech is decelerating.